Hello and welcome. In this video, we walk through step-by-step how to record a grant. Note that this is an educational video, a training video, and it's not professional advice. Let's start with a scenario familiar to many of us. It's 5:30 p.m. on a Friday evening. The board meets tomorrow, a Saturday meeting, and you are staring at a file named Grant Report Final version 3 do not delete .xlsx. You're doing this because the accounting software you use doesn't match the grant budget. You are manually cross-referencing payroll allocations and praying that the columns fit. This is called the spreadsheet nightmare. And it happens because standard accounting asks, are we profitable? And you use a standard accounting application. Nonprofit accounting has to answer 4 much harder questions for every single dollar. What did we spend it on? That's called the natural classification. Why did we spend it? The program classification. Whose money was it? The grant. And how else does a donor want to see it? And none of these questions are related to cash flow. The path from complexity to clarity follows here. We stop treating every grant like a unique item and start treating them like data. We use a diagnostic approach. Think of this funnel as your intake process. Every time a client hands you a document, a contract, a letter, an email, you push it through this funnel. It forces you to answer 3 specific questions in a specific order, and if you skip a step, you will likely misstate revenue. The 3 questions that unlock the correct gap treatment are: 1. Is it a contribution or an exchange? Are they buying something or giving something? Is it a conditional or unconditional grant? Do we have to earn it or is it ours immediately? What are the donor restrictions? How do we have to behave with this money? And if you answer these questions in sequence, the journal entries become clear. The fork in the road here is the concept of commensurate value. Ask yourself, does the person giving the money receive something of roughly equal value in return? If the answer is yes, like a government contract for services or a ticket to a gala, that is an exchange transaction under ASC 606. They are a customer. If the answer is no, they're giving support to the mission with no direct benefit, and it's a contribution under ASC 958. This distinction is vital because customers and donors trigger completely different revenue recognition rules. If you determine that it's an exchange, ASC 606, you follow the matching principle. You recognize revenue only when you do the work. If you get cash up front, that's deferred liability. Look at this mixed sponsorship example. These are tricky. A donor or sponsor gives $25,000 for a gala. They get $2,000 worth of dinner tickets and ads. You must split this entry. The $2,000 is deferred revenue, a liability, until the gala happens. The $23,000 is contribution revenue recognized immediately. Now don't book the whole $25,000 to event income. The IRS and your auditors will flag that immediately. Now, if we decided it's a contribution, we move to question number 2. Is it conditional? A contribution is conditional only if it has 2 things. 1, a barrier, a measurable target. Example, serve 1,000 kids or spend this money on allowable costs. 2, a right of return, a clause that says, if you don't do this, give the money back. If it's missing either one, it's unconditional. Note that a standard progress report that's required is not a barrier. That's just an administrative task. So, recording conditional grants results in the most common mistakes in nonprofit bookkeeping. Let me repeat that. Recording conditional grants results in the most common mistakes in nonprofit bookkeeping. If a grant is conditional, you cannot recognize revenue until you overcome the barrier. When the cash hits the bank, you debit cash and you credit refundable advance. Don't use deferred revenue. I repeat, do not use deferred revenue. That is for customers, exchange transactions. For grants, the liability account is refundable advance. You only move it to revenue as you meet the milestones. Note that if you have any doubts about whether or not a grant is conditional, be sure to check with your accounting or legal professional for a proper determination. Conversely, if there is no barrier, even if the cash hasn't arrived yet, you must recognize the revenue now. Yes, immediately. If a foundation sends a letter, say on December 31st, promising $100,000 for next year, you book that revenue in December 31st if it's unconditional. So to do that, you debit grants receivable and you credit contribution revenue. Your board might hate this because they don't have the cash yet, but GAAP requires you to book income when the promise is made. Also, watch out for multi-year pledges. Those need to be recorded at present value. That's a topic for a completely different video. Finally, we move to question number 3. We know it's a contribution and we've recognized the revenue. Now, which piggy bank does it go into? GAAP mandates 2 classes of net assets. One, without donor restrictions. This is your operating fund. And 2, with donor restrictions. These funds are tied up by purpose, example, the youth program or time for 2025. Tag the revenue to the correct bucket immediately. Now, here are the mechanics of spending that money. It brings into focus the concept of the release. When you spend $50,000 on the youth program, you do not record a restricted expense. There's no such thing as a restricted expense in GAAP. Instead, you record a normal expense and then you do a reclass entry. And that reclass entry is a debit, net assets released from with donor restrictions, and a credit to net assets released to without donor restrictions. On the P&L, this looks like moving money from the right column to the left column. The net effect on the bottom line is 0, but it proves you followed the donor's wishes. A quick detour on non-cash gifts. Clients love to ask, can I book the volunteer time for people stuffing envelopes? The answer is no. You can only book donated services if they pass the 3-part test. 1, is it a specialized skill? Legal, accounting, medical, etc. 2, is it performed by a professional? 3, would you have paid for it otherwise? So, for example, if a CPA donates an audit, you book it. Debit, professional fees, credit, in-kind revenue. If that same CPA paints the office walls, you book nothing. So let's put it all together. The flowchart is your cheat sheet. 1, is it an exchange? Then you go with ASC 606 and deferred revenue. 2, is it conditional? Then it's a refundable advance till the conditions are met. 3, is it restricted? Net assets with donor restrictions. Print this slide out and tape it to your monitor. It solves 95% of grant accounting confusion. Now, this is the Holy Grail. This is what we're aiming for. When you enter a bill for brochures, you shouldn't just hit printing expenses and walk away. We want a multi-dimensional view. The what, that's the printing account. The why, the youth mentoring, a functional class. The who's, the Oak Foundation. The restrictions, with donor restrictions, location class. If you code this one transaction correctly, your software can generate a P&L by grant, by program, or by restriction without you ever having to touch Excel and deal with the spreadsheet nightmare. We'll wrap up here. Why do we do all this work? Why do we care about barriers and restrictions? It's not just about audit proofing, though that's nice. It's about stewardship. When you provide this level of clarity, you build trust with funders. You free the executive director from financial anxiety. You turn financial data from a compliance headache into fuel for the mission. Thank you for your time, and let's go decode some grants. Please share your questions, comments in the comment section below, and subscribe for regular nonprofit news briefs and social videos like this one.